Welcome. We are here in chapter 13 to start talking about current liabilities and contingencies. Contingency is basically a liability that is required to have something happen in order for it to become a liability or whatever. Okay, so here let's talk about what a liability is. All right, it's something that is occurring right now that will eventually cause us to pass off assets or some kind of resource to another person. We owe something. Basically, that's kind of what you're looking at. It says an economic benefit that has arisen. What I like to say is that liability is some past obligation, that a current obligation due to a past event that will be paid in the future. Bottom line, that's kind of what I'm looking at as far as liability is. Current liabilities are anything that we will have that liability criteria filled within 1 year or the operating cycle of the company, whichever is longer. When I say current liabilities within 1 year, that's what I'm talking about. If by chance there's ever a time you're going to deal with a company that's operating cycle is longer than a year, then rock on. We go with a year because that's what like 98% of companies do, probably, maybe even more than that. I don't know. Current liabilities, I don't know that I agree with the fact that it's satisfied with current assets. I guess if I think about it, you're looking at paying it off with cash and things like that. But I don't know that I would necessarily say that it's required or that that's part of the characteristics, because you can certainly pay off your current liabilities with long-term assets, especially if you're going under. I don't know why else you would, but it is possible. I don't know, but book has its reasons. So current liabilities need to be recorded at their present values because they're due in such a short period of time. Here's a list of your most common examples. You have your accrued expenses. Those are expenses you've incurred but have yet to pay for. A lot of times that's your salaries payable, a lot of other payables, things that you owe. Looking for unearned revenue. I don't see deferred revenue anywhere. That's surprising. Deferred revenue is definitely one too, though. Unearned revenue, basically. So here's an example of General Mills's liability section. Is your current liabilities focus. You got your accounts payable, current portion of long-term debt. Was that on there too? It was not. Current portion of long-term debt means if you owe money and it's a 5-year loan, you're going to have stuff you pay off in the first year. That's the current portion of your debt that's otherwise classified as long-term. So that's what that means. Then you have notes payable that are borrowings from the bank that you owe but are owed within the 12-month period. Sometimes they could be a maturity date. You've got it and it's only been 3 months and it's only the amount of time you're borrowing on it. Otherwise, it could be notes that are longer term that are due, and that's the current portion of our long-term debt is where we put those anyway. So, and then other current liabilities are anything you want. Notes payable definitely will show you exactly what is in here. This is a note to the financial statement. This one is note 9 for General Mills. Kind of breaks down what is in the notes payable and the we got financial institutions you owe money to, and then U.S. commercial paper. This one is okay. Committed and uncommitted credit lines. Basically, you have debt that is committed to something. This is like a kind of a more advanced concept. Just know that that exists. Accounts payable and trade notes payable. The basically difference between the two is like when we were talking about in accounting 111, if you have a debt that is owed to you and instead of paying the accounts payable, they ended up saying, hey, we'll give you a note and pay you some interest if you'll accept a later payment. That's your trade notes payable. It's basically that. Your accounts payable is usually due within 30 days, no interest. It's just you're giving them the courtesy of having 30 days to pay it off. Here's your characteristics of your notes payable for short term. You can read that there. The bottom line is it's just things we use to kind of get us through the short term if we need to. Credit lines, it's, here's your committed, non-committed. It's the difference between a formal agreement or an informal agreement. Anyway. Yeah, I mean, bottom line is, I guess it's a matter of the formality of it. You really don't. It's not the. It's not that it's a big deal. I guess just however you have it. So, in your notes to financial statements, you'll indicate how much you have as far as lines of credit, things like that. You can pause and read this if you want. All this is just kind of information that you should know, kind of categorizing things where, how to identify them in your notes, things like that. So that's kind of what we're looking at for this one here. When we pay interest for anything like our current notes payable or anything that requires interest, we have to take what we owe, multiply it by the annual percentage rate, and then the time to maturity. And oftentimes, especially with current liabilities, you're looking at months over total months. Okay, so maybe it's a 3 month period. It's going to be 3 divided by 12 for that time to maturity. So it just depends on the circumstances. So let's look at an example here. On May 1st, Affiliated Technologies, a consumer electronics firm, borrowed $700,000 cash from First Bank Corp under a non-committed short-term line of credit arrangement, issued a 6-month, 12% promissory note. Interest was payable at maturity. This on May 1st, it's owed November 1st. We borrow the money, it's a debit to cash, credit to notes payable. That should not be any earth-shattering journal entry. And with respect, paying it off shouldn't be all that much either. I mean, we've done this stuff before in financial accounting. 700,000 times that 12% annual interest rate. And then we're going to multiply it by the result of 6 divided by 12, or half, because that's what 6 divided by 12 equates to, 1/2 or half. So that's the amount of interest, is half of 12% of that. So that's $42,000. And we end up paying the cash of $742,000, as well as paying off the note payable. Okay. All right, non-interest bearing notes due in 6 months. So we got inventory worth $658,000. Bottom line is we're looking at it discounting this note because we can't. We have to, in all material respects, we gave them interest. Okay, it's a non-interest bearing note. I don't even know why they do it anymore, because we got to log the fact that it was interest anyway, and they're probably going to be logging that they got an interest revenue also. So the $42,000 difference between what the inventory we got and the issuing amount of the note is going to be the interest according to that. So we're going to discount that note. And as we discount it, if this were a longer term note, as we're going to get in chapter 14, we're going to discount that that amount to interest expense over time. And so that's kind of how we're going to look at it that way. Okay. So non-interest bearing note, we got to find out what the percentage is here. And so we're going to take that 42,000, which is interest for 6 months, and divide it by the amount we borrowed. We're going to find out what the rate for 6 months is, and then we're going to multiply it by 2, which is that 12 divided by 6. It's the inverted rate at which we got to that point, which was for 6 months. So we're going to basically just multiply 2. So our effective interest rate, or the interest rate we essentially gave to this company by making this arrangement, is 12.76%. I would want to know how to do that, because that's a very common question we're going to see in this chapter. Okay. All right, securing loans. There are many ways we can do that. One of them is we could pledge our accounts receivable, basically saying, hey, this is our collateral. If we don't pay it back, you basically get to take these debt other people owe to us as that payment. The other one is factoring, and that is where we actually just sell it outright to the financing institution, and they will collect on it, and that's kind of their money now, and that's what they do it. And a lot of times, just like if you're familiar with the when bad debts go bad, places will buy that bad debt and trying to have people still pay it back. But then if I bought this bad debt from somebody and I paid $5 for it, but they owe them 500, which they do get pennies on the dollar. then if they collect even $200, they've made a lot of money in that sense. So they're willing to work with them and everything. So that's kind of what factoring and not pledging. Pledging is just securing the loan. Factoring, you're not gonna sell it for the full amount of it because no one's gonna want to do that. They're gonna sell it for less than what they're supposed to collect for. So if I had an account receivable and I know I'm going to collect $2,000, I might sell it to someone for 1,600. I need the money today. I need the cash today, and so in as a way of getting that money today, uh, we're gonna sell that to someone else to collect on it. Personally, for me, I don't know why people would factor. It's a thing. People do it all the time. I don't know why, because if your business is such that you need cash all the time, why are you giving credit to anybody? I mean, I don't know. Maybe rethink your model. I don't know. Acting's never been something I understood why people do it. But I'm a big proponent of no debt personally too. So in fact, I won't get into personal stuff. Commercial paper, all right. Unsecured notes we sold, of course. In this case, it says that sold a minimum dominations of 25,000 with maturities ranging from 1 to 270 days. Bottom line is, beyond that, you have to register with the SEC. That's probably why it's 270. So, yeah. Anyway, it's just information. I'm just trying to see if there's anything really worth going over. Interest often is discounted at issuance of the note. Yeah, we already talked about this kind of stuff. So. Here's your real world financials. Repayment of secured borrowings depend on cash flows generated by the restricted assets. Disclosed in commercial paper. Chapter or note 6. Why didn't they put those in order? 6, 12, and then 6. It's weird. Long-term debt in part, talking about the commercial paper program, things like that. It's kind of what you'd expect to see in the notes to the financial statement. Let's move on to accrued expenses, or in other words, payables. So bottom line is anything that you can get a bill for that you have not yet paid can be an accrued expense. Salaries, income tax, interest. I mean, there's so many other things you could go on wages payable. It's kind of like salaries and you know, basically anything. Here's a way to disclose that information. Note with this is a note with accrued interest. Why did we bounce back? Weird. Okay, whatever. So in this case, we're borrowing $700,000 from First Bank Corp under a non-committed short-term line of credit arrangement and issued a 6-month 12% promissory note. Interest payable maturity. I mean, we've done this. I don't know why they do this at us right here. Maybe it's like a learning of the last couple of sections. I don't know. And then note with accrued interest is what we do when we pay it off. Okay, we're gonna debit that note's payable, interest expense, interest payable. Sorry, I'm gonna go back one really quick. Accrued interest as of June 30th. So we accrue it. That's probably what they're showing. So we're stepping over that quarter or the half year, and then we're going to finish paying off. Again, these situations and these contexts should not be unfamiliar to you. You should be very familiar with how to do this accrued interest. I'm going to go back 2 slides for the accrued expenses because I don't feel like we really talked a lot about this. The reason for that again is because you should again be familiar with this. We should have done it. But when we record these accrued expenses, we're going to debit the expense, credit the payable. So if in the salaries situation, debit salaries expense, credit salaries payable, income tax, we're going to debit income tax expense, income tax payables, credit, and get the idea. Interest expense is debited and interest payable is credited. Now I'm going to jump forward 2 slides. Third one here, we're talking about salaries, commissions, and bonuses. Again, we keep saying again, but this is stuff that we did cover in chapter. I can even give you, if you took my class, it's chapter 11 in the book. That's the one we're in now, but the one we did when we were in accounting 111 or 112, or if you're in my 112 class. But anyhow, I'm sorry, 211 class. So we could have vacation, sick days, other paid future benefits such as pensions and things like that. I don't think this chapter we get into that really specifically as far as pensions go. That's a whole ball of wax in and of itself. But this is paid future. Other paid future absences is what I said, not pensions. Pensions aren't absences from retirement. Payment is probable, and I would say it depends on your company's policy too, because vacation days that you accrue, most companies that I know is going to pay that out to you when you leave, if they let you carry it over. If they don't let you carry it over, then it's just gone. A lot of companies are moving to that. So sick days, people don't get those as much. One place that my brother worked for that I actually thought was really good, they gave their employees 3 weeks of leave. There was no vacation, there was no sick, there was nothing. It's just if you're sick, you're using this leave. If you're going on vacation, you're using this leave. So it ultimately made it to where, hey, you're sick, that's fine. It's just you're not gonna be able to go on a longer vacation if that's what you want to do. So it really kind of put a kibosh on the abuse of the sick days and put in, people made them a little more accountable, which is fine. But because vacations, like I said, usually get paid back, sick days don't. So if we have, let's see what this chemicals has 8,000 employees, each employee earns 2 weeks of paid vacation per year. Vacation time not taken in the year earned can be carried over to subsequent years. During 2027, 2,500 employees took both weeks vacation. But at the end of the year, 5,500 employees had vacation time carryovers as follows. 2,000 employees had 1 week. 3,500 had 2 weeks that they did not take their vacation. During 2027, compensation averaged $600 per week. You would never do this based on an average. I mean, you would use real numbers. In 2028, when vacation time carried over from 2027 is taken, the actual amount paid to the employees is $5,700,000. Okay. So, chunk of change. Let's look and see how we're going to do this. Okay. So for journal entry, when the vacations were taken, we debit to salaries expense and credit to cash. We pay them on their paycheck. It's part of salaries expense. But when the vacations were taken in 2027, that doesn't make sense. So we just said that. So what they're doing here is we're still expensing. I think what they meant to say was when vacations were not taken in 2027, what that happens. So we did not take the vacations. When vacations were not taken, or basically we're carrying them forward to the future accounting periods, we're going to debit that salaries expense because that was when they were technically accrued. Okay, they're accrued, and we're going to put that as a liability. It's just like a regular accrual of a deferred expense. Okay, we're taking the or not a deferred expense, excuse me, accrued expense. We're taking the expense today because that's what the accounting period that it was developed in. We had the expense in that accounting period. We're going to chalk it to a liability. And when they use that liability in the future, we're going to expense it then. Now, the thing about that is if employees get raises, you can incur the debt as, like, let's say you're making $20 an hour, you incur the debt at $20 an hour, but then when you actually take the leave, you're getting paid $22 an hour because you got a promotion or a raise or something. So what happens there, and that's what this is showing you here, is if, okay, now 2027 vacations were taken in 2028, we debited that 50 or that 5,400,000, but because some people got raises, we had to increase and expense $300 more to reflect the amount of money in addition that they had earned during, or that the rate of pay increase that they had earned during the current accounting period. So that's why we're going to do it this way. Okay. So we're going to get rid of the liability as we use it, and then debit salaries expense for anything in addition to that and credit the cash. It's actually kind of, when you think about it, it makes perfect sense, I hope, because it's kind of cool. Annual bonuses. This is the one thing I really hate, but we're probably have to calculate some of this. Is a lot of times they're like, well, we want to have this net income, and so we want to have this net income after our bonus, and so you got to do this backward math kind of stuff. I don't particularly care for it, but whatever. Anyway, these are your reasons why you might get a bonus. They want you to increase the stock price. They want you to do various things, your income, whatever. There could be non-financial. Basically, if you understand what the balanced scorecard is, and if you haven't learned this, you should have picked it up in managerial accounting. It's where you have several financial and non-financial goals to meet in order to obtain a bonus. And that's really ironically what this slide is telling you, although it's not really talking about how to do the journal entries for it, but whatever. Liabilities from advanced collections. Okay, this is basically the prepaid expenses. We've got unearned revenues, what we've got here for us. This can come in the form of gift cards, deposits, or collections from third parties. If the deposit is refundable, then you have a liability as you accept the cash. So your debit to cash, credit to liability as a refundable deposit. I would probably, I think they show this as a way for you to learn. I wouldn't put liability hyphen refundable deposit. It's just a refundable deposit, and we know it's a liability. I think they do that just so that you can kind of see what it's supposed to be, what it looks like, and how that works. Okay. Now, when the containers are returned, I didn't even read the question here. So I guess deposits collected, containers. What are we? Chemical. Okay, so we sell chemicals if they bring the container back. If they don't do it for 1 year, then we keep the money. Okay. 90% of the containers were returned. Deposits charged are twice the actual cost of the containers. The inventory of container remains on the company's books. Deposits forfeit. Yep. Okay. So in this situation, when the containers return, we got 90% of them coming back. We're going to debit that liability, credit cash. Yeah, we're paying them the money back for the cash. Okay. Oh, yeah. But when they forfeit it, we're going to have to call it revenue as though we sold those containers. And so we're going to go ahead and make our normal sale account for inventory, debit the liability of the refundable deposits, because we've already got the cash, credit the revenue for the sales of the containers, and then take care of your cost of goods sold and inventory containers. What if we get advances from customers, basically unearned revenue in the form of gift cards, magazine, any kind of subscriptions? I like magazine subscriptions. So I'm not even sure they do. I guess I see some magazines. I know they don't do newspaper subscriptions anymore. Layaway deposits. I'm pretty sure that layaway is a thing still. My mom used to. I remember doing layaway with my mom. Um, Special order deposits. I don't even know what that is, honestly. Airline tickets. Oh, I guess you buy the ticket. Any tickets in that case. Yeah, you buy the airline ticket and then they don't get to charge it as income until you actually fly. Same thing with concerts. That's a common thing, or sporting events. You buy the ticket, they don't get to count as revenue until the event happens. I tell this story during COVID. I go to the Fiesta Bowl, and during COVID they canceled it, so they had to refund us the money, and they never got to book it as revenue. I thought it was funny. They're like, you could donate it to our charity. I'm like, no. Or you could apply it to next year's tickets, which is what I did. I like going to those games. For the most part, I'm starting to kind of burn out, but I need to find my happiness again. So when we get it, we can debit, cash, credit, whatever the unearned revenue account is. In this case, it's magazines, deferred subscription revenue. I'm going to go back a slide where we just were. You could call it whatever you want. Gift certificates. You could call them layaway. I mean, it doesn't matter as long as you understand it's something you haven't earned yet and that you will earn once things are delivered. Then with this magazine, you deliver one. Let's say, how long is the subscription for? Oh, we're taking averages again. Oh, this is in millions. Okay, it's not just dollars. So December 31st, the average subscription was 1/4 expired. Again, this is like high level. We're not really going to be doing this high level stuff. You're not going to be, maybe you will. I don't think that's the case though. But 1/4 is expired. So you're going to count 1/4 of it. 20 divided by 4 is going to be $5. $5 million. So you're going to debit the deferred subscription revenue and credit your subscription. You've earned it now. That money that you probably already spent, you don't have to send it back. Gift card, same thing. There is something called breakage when you have the remote possibility that the gift card will be redeemed. You can record it as a revenue at that point. In some jurisdictions, though, you can't. They will not let you cancel a credit card or debit card. I just committed the cardinal sin. I called it a D card. I was trying to say gift card, but some jurisdictions won't allow them to expire. So if you lose it and somehow or another, if someone finds it and uses it, they have to honor it. So I don't know that Arizona's that way. I'm pretty sure that California and all the left and right coasts are, but some of the other places aren't. I'd have to look it up. I haven't looked up that law in Arizona in a while. I haven't had to deal with it much. So when we sell them, we debit cash, credit, gift card, deferred gift card revenue for the amount. As people are using them, we debit the deferred and credit the revenue. And once they expire, you debit the gift card revenue, the deferred gift card revenue, and credit the gift card revenue again. Okay. Hopefully this is all pretty intuitive. It's kind of like, yeah, this kind of makes sense. All right, what happens when we collect for third parties? Like we're talking the sales tax is the big one, but other payroll type contributions, we're collecting it and then we're distributing it to whomever it belongs to. It's never counted as revenue. Please know that it is never, ever revenue. All right, but let's look at these as we go. Third parties here, the most common one is by far sales tax. Okay, you're selling something. We collect the cash. The sales revenue for the item that they purchased is $100. Then the sales tax is $7. We collect that $7 as a liability, and then once we remit that payment to the state, we are going to, or in this case, I guess it's state is 4 and local 3. Okay, whatever. Bottom line is we remit the amount to whomever it belongs to. We're going to debit that sales tax payable, and we're going to credit cash and send it to whomever it belongs to. Who or whomever, I don't know. I'm not an English major. Current and non-current classifications, current maturities of long-term debt. You're going to have bonds, notes, lease liabilities, deferred tax liabilities. All of these are basically just stuff that's due within the 30 days, the 1 year account period, the operating cycle of the company. Okay. Bottom line is that's all we're doing. Okay, it's just it'll oftentimes you look at a financial statement, it'll say the current portion of bonds payable, current portion of notes payable, and yeah, that's what we're looking at and talking here. Right now, let's go ahead and do the word. I want to make sure I get that in, and the word is December, as in the month, DECEMBER. Remember to put that into the quiz for chapter 13. That name again, or that word again, is December. DECEMBER. Delta Echo Charlie Echo Mike Bravo Echo Romeo. December. Don't need to capitalize it, but if you do, it should count anyway. December. Any obligations that are callable by the creditor. Creditor can basically say, hey, look, you owe it to us, we're calling the debt. One of the famous situations of that is in It's a Wonderful Life, when the run on the bank happens in that movie. The bank called the debt of the savings and loan. They paid them the money they had that fulfilled that obligation, which left the savings and loan nothing. And George Bailey had to use his personal money to pay off the money that people wanted. And anyhow, it was that's what it means callable. The bank, you can call whenever you want. You owe it to me, give it to me, I want it now. There's probably going to be certain legal obligations that has to be, hey, you got to give me a week's notice, stuff like that. I mean, it's not just a cut and dry thing, but for accounting purposes, if it's callable, we gotta identify that. And if it says the debt that is callable by the creditor in the upcoming year operating cycle, even if the debt is not expected to be called, okay, even if it's not expected to be called, but we have that as callable, we got to make sure we're tracking that. Okay, when the creditor has the right to demand payment because an existing violation of a provision of the debt agreement makes it callable, or a debt is not yet callable but will be callable within the year if an existing violation is not corrected within a specified grace period. Bottom line is, if you know you're screwing things up with this, you got to identify that, yes, we got to classify it as currently maturing debt in the current liability section. We expect to refinance short-term debt, then we must the company must intend to refinance on a long-term basis, and the company must actually have demonstrated the ability to refinance on a long-term basis. So you can't just do it first time. You got to do first time. You got to take it in the shorts. Then after that, you've demonstrated that you can do it, and then you can do it. Okay, you can refinance it to longer term debt. All right, so in this case, refinancing short-term obligations. Oh, good. Brahms Bros Ice Cream had 12 million of notes that mature in May 28, and also had 4 million of bonds issued in 1998 that mature in February of 28. On December 31st, 2027, the company's fiscal year-end management intended to refinance both on a long-term basis. On February 7th, 2028, the company issued $4 million of 20-year bonds, applying the proceeds to repay the bond issue that matured that month. In early March, prior to the actual issuance of the 2027 financial statements, Rom Bros negotiated a line of credit with a commercial bank for up to $7 million anytime during 2028. Any borrowings will mature 2 years from the date of any borrowings will mature 2 years from the date of the borrowing. So, screw lifers. Anyway, bottom line is I went back to this. Current liabilities is going to be that notes payable, right? The 12,000 minus the 7,000. So that's the 5,000 I think that we were paying back. Where was that? I thought I saw something. Anyway, it's 12,000 that we issued for the millions in that are maturing, but that we're going to refinance with 7,000 of that 2-year debt. So 5,000 is what we're paying off, the difference between that two. The 7,000 goes to that notes payable that we're having that open bank account for, and then the 4 million for the bonds we're issuing on February 7th. Alrighty, we don't care about IFRS, loss contingencies. We have to know these 3 different topics: probable, reasonably possible, or remote. Okay, because how these work are going to depend on how we account for them. Here's your note example. We're going to have some more, I think. Yep. You can pause these videos at any point and look at these as long as you need to read them. I'm not going to read them or go over them. It's just companies identifying their contingency disclosures. If the likelihood of a loss contingency is probable, we are going to record it as a liability and disclose it in a note. That's if the dollar amount of the potentially loss is known. If it's unknown but reasonably estimatable, we'll still do the same thing. But if we don't know how much, but we know it's going to happen, then we need to disclose it as a note only. If it's reasonably possible, disclosure only. Doesn't matter what the scenario is. If it's reasonably possible, we got to disclose it. If it's remote, except for certain guarantees and other specified off-balance sheet risk situations, we are going to not have to do anything. Okay, we'll have to disclose it. When the loss contingency is accrued as a liability, we're debiting whatever the loss or expense is, crediting the liability. When it's resolved, if it's a non-cash asset, we're going to debit the loss and credit the or the expense and credit the asset. That's if it's a non-cash. If it's paid in cash, it's going to be credit to the cash. One of the biggest loss contingencies is a warranty or a guarantee. Okay, warranties and guarantees are things that basically, hey, if something goes wrong, we got you. Most of the time, places have a 90-day. Basically, if this breaks down within 90 days, we'll fix it for you. Okay, it's a warranty, but we also sell extended warranties. I think we're going to get into that, which is way better. So when we have sales, we're going to do the $2 million, but our experience says that 3% of the sales are going to be estimated based on industry experience indicates warranties of 3% during the first 12 months following the sale and 4% the next 12 months. Okay, so we're giving these people 2 years. 2-year warranty against defects. Okay, so ultimately we got 7% we're expecting. So when we go here, we're going to take 2 million times 7%, and that's our warranty liability. We're going to debit the warranty expense, credit the warranty liability. We're basically pre-funding this, what we expect to be having to pay out. And then when warranty claims are made, we're going to debit that liability and credit the cash or the salaries payable or parts or whatever account we're using to track that. No big deal. It's all good. Just whatever we use. This is basically talking about estimates. Now, remember, we're giving this the best estimate we can. We don't know really. Maybe something changed at the factory and things are different this year than it was in the past. We're just giving it the best shot. We may over compensate. We may undercompensate. There's ways to correct it. But ultimately, we're just giving it our best estimate. It's just like depreciation. We're really not saying that this thing's wore out or whatever. We're just saying that's how much we're spending over the cost. And that's kind of what we're trying to do here is is expense what we think it is today, and then have that liability amount to fund these warranty situations later on down the road. So in this case, we're looking at the probability versus the warranty costs, okay? And then we're going to, well, I don't know what we're doing here. Hold on, sorry. So 2 million shares, industry experience indicates the following probability distribution of potential warranty costs. So we expect the probability of paying $50,000 in 2028 is 20%, 60,000 is 50%. You get the idea. Okay, you get the idea. So I guess what we're trying to do is we're trying to agree with a service firm, say, hey, you handle all of our warranties. We'll give you this money plus 5%. And that's what they're trying to do, I think. So let's go to this next page. We're going to take time value of money. We're arranging a service firm that requires the cost for 2-year warranty period. We take each one of those that we did right here, and we're going to take the amounts, multiplying by the probability to come up with the amount of money it is. Then we're going to determine the number of periods at 5%, come up with how much money we believe we need to give it to them in order to cover the liabilities. And then once we get that money, we're debiting warranty expense, crediting warranty liability. Hey, extended warranties. That's kind of a different ballpark because we're generating revenue in this case. So if the priced and sold separately from the warranty product, it's going to be a separate performance obligation. Hopefully you remember about the performance obligations we talked about earlier in the semester. We're going to recognize it as a deferred revenue until the contract period is over. Sorry, I'm trying to turn on my fan. It's starting to get a little toasty in my office here. And we're going to recognize it over the straight line basis here. So if we have a warranty, is this $60? Yeah, $60. Sell a $6 extended warranty covering 3 years. As long as there's nothing happening, whatever. I mean, even if it is, we bought it, we got it. It's going to be deferred revenue is how we earn it, and just going to over 3 years identify that we earned it. So it's pretty straightforward there, hopefully. Any litigation, you're getting sued, okay? You got to determine whether the accrual of loss from pending or ongoing litigation is rare. Accrual of a loss from pending or ongoing legislation is rare. Well, companies should provide extensive. I'm sorry, I just had to read because it depends on the book again, like kind of how they explain this, whatever. But bottom line is you're going to look at this in part the way we were talking about contingencies, warranties and stuff. We're looking at this as like, is it estimatable? Is it probable? Is it likely? Bottom line is we got to kind of come up with that and put this in the footnotes. We may have a liability, but it depends on the circumstances. Okay. Is it probable that a claim will be asserted? If the answer is no, we're done. We don't have to do anything. But if yes, then the claim has been asserted, if it can be asserted or will be asserted. And at that point, we need to book a liability there. And here's IFRS. We don't care about IFRS. You can actually pause this and read the gap side if you want. I just see IFRS and it sends the vomit from my stomach to my mouth. I hate IFRS. A gain contingency is an uncertain situation that you might result in a gain. In this case, you're suing somebody else. You have some situation where you're going to gain money. I don't want to say for no reason, but for no effort on your part or whatever. So we disclose these in the notes just because we don't know for sure. And we want to take the conservative approach, saying, yeah, we don't know. Related payroll liabilities, again, you have the withholding, the voluntary deductions, and the payroll expenses. This should be just another recap of what you did in Accounting 111. This is Appendix 13 anyway. Just anything that you have withholding that is, even if it's voluntary, whatever, you're going to pull it out and you're going to journalize it as a some type of expense, and then credit whatever payable it's associated with. Okay, here's the journal entry that it looks like. you can pause here and look at it as long as you want. But otherwise, that is our chapter 13. I hope you enjoyed this journey. Remember to like and subscribe. I'm just messing with you guys. You can do it if you want. But have a good one. We'll see you guys in future videos and take care.